The stock market. At some point or another, we've all come across it. Be it in Hollywood movies, national news, or on Reddit forums, the stock market seems to be everywhere. To outsiders, the world of investing can seem extremely foreign. Buy, sell, and hold are relatively easy concepts to understand, but NASDAQ's glossary of stock market terms reveals an entire language dedicated to stock market investing. But the complex world of the stock market that we know today is far from what it was at its humble beginnings. In this video, we'll explore the history of the stock market. We'll talk about its origins and all of the developments which have contributed to what we know as the modern day stock market. If you find today's video interesting, don't forget to show your support by leaving a like and subscribing to the channel. Believe it or not, our story does not start in America with the New York Stock Exchange. Instead, we're traveling to Antwerp, Belgium, and the year is 1531. At this time, a building known as the Handelsbeurs was erected to serve as the world's first dedicated stock exchange building. But why Belgium? Prior to 1531, the cities of Antwerp and Bruges had become commercial hubs for international merchants. Goods from around the world would land at these ports, and the local innkeepers would assist the traveling merchants in exchanging and selling them. A family of innkeepers known as the Van der Beurs are accredited with playing a very important role in facilitating these early trades. So much so that the word bourse was derived from their family name, meaning stock market in French. Interestingly, although the Handelsbeurs is seen as the first stock market institution, no company stock was actually traded there. Instead, traders at Handelsbeurs dealt in bonds. A bond is effectively an IOU between two parties, where one party gives money to another party on the condition that the lending party will receive interest or coupon payments from the borrowing party on top of repaying the borrowed amount. To see the first instance of formalized stock trading, we have to go to Amsterdam in 1611. It was at this time when the Amsterdam Stock Exchange opened its doors. Formerly known as the Hendrik de Keyser Exchange, this was the first legitimate institution which facilitated stock trading. But why Amsterdam? While 1611 might be the date given to the first official stock exchange, it was actually 1602 when the first ever initial public offering or IPO of company stock was held. The Dutch East India Company was the first company to publicly invite anyone to invest. What's more, they also publicly stated that shares in the company could be transferred between parties once purchased. This was revolutionary because prior to this, investors would have to wait typically 3 or 4 years to get their money back. When the IPO had closed, there were 1,143 investors in the Dutch East India Company. The company had specified that the formal route for transferring shares was via a bookkeeper. However, in reality, Amsterdam merchants would congregate in locations like Newbridge or St. Olaf's Chapel, and it was at those locations where the majority of share trading was done. This went on for some time, and in 1607, it was decided that an official stock exchange building was needed, hence the opening of the Amsterdam Stock Exchange in 1611. What's interesting is that the opening of the exchange came with rules which dictated the official trading hours and deemed that any deals made outside of the exchange would be null and void. Many of these early rules are still seen today. If you want to learn more about the Dutch East India Company and the Amsterdam Stock Exchange, I highly recommend checking out worldsfirststockexchange.com. So we've established that the early iterations of the stock market were born in Antwerp and Amsterdam. But how exactly did the stock market make its way to the United States of America? The early roots of the world's largest stock exchange, which we now know as the New York Stock Exchange, came from beneath a buttonwood tree. In 1792, over 180 years after the founding of the Amsterdam Stock Exchange, a group of stockbrokers and traders gathered on Wall Street in New York City and signed the Buttonwood Agreement. Prior to this agreement, a financial crisis earlier that year, spurred on by a man known as William Durr, caused widespread mistrust among the investing community. Durr's actions are regarded as the first ever instance of insider trading on Wall Street. So it was decided that leaders within the community would come together and create a legitimate trusted network of brokers from whom financial securities could be purchased. The agreement brought order to the previously sporadic nature of stock trading in the US. This would lay the foundation of what would later become the New York Stock Exchange. Back then, only a handful of stocks could be bought and sold, compared to the thousands of companies which are trading publicly today. As the US economy went from strength to strength, so too did securities trading. By 1863, 71 years after the signing of the Buttonwood Agreement, the New York Stock Exchange had gotten its name and its permanent location at 18 Broad Street. Despite the signing of the Buttonwood Agreement in 1792, the title of the first official US stock exchange went to the Philadelphia Stock Exchange, which was formed in 1790. You might find it surprising to hear that Philadelphia was, for a time, considered to be the financial heart of the United States. What's interesting is that New York, being the more easterly port, will be the first to receive all the latest news from Europe as ships arrived. Cunning traders could use this early information to make a quick dollar. To prevent market manipulation on the Philadelphian exchange, flashes of light resembling code were used to send signals from New York to Philadelphia about the latest stock prices. Bear in mind, this was before the telegraph was introduced in 1846. The stock market in the United States was up and running. From Antwerp, Belgium in 1531 to New York City, America in 1863. But of course, this was still very early days, and no one could have guessed just how far innovation would go by 2022. But more on that later. Two innovations which have become synonymous with the stock market are both the Dow Jones Industrial Average and the Standard & Poor's 500. Investors still, to this day, use these measures to assess the performance of the stock market as a whole. The Dow Jones was introduced in 1896 and was founded by Charles Dow and Edward Jones. Originally, the Dow Jones was made up of 12 companies which were chosen to represent key areas of the US economy. The idea behind the Dow was fairly simple: to give investors a window into the market. But it wasn't until 1941 that one of the most iconic financial institutions in the world was born. Standard & Poor's came into existence when Standard Statistics and Poor's Publishing merged. This partnership would go on to become the household name of the investing world. Perhaps their greatest and most well-known contribution came in 1957, when the S&P 500 index was introduced. This marked the introduction of the world's first computer-generated stock market index. The purpose of the index was to measure the performance of the 500 largest companies listed on the New York Stock Exchange. Since its introduction, the S&P 500 index has been regarded as the best representation of the US stock market as a whole. What came next can only be described as revolutionary. In 1973, the first investment fund tracking the S&P 500 was introduced. This allowed investors to easily access the returns of the market as a whole. Vanguard, who we're all familiar with, followed suit with their first S&P 500 fund in 1976. Just under 200 years earlier, 24 signatures met a page under a buttonwood tree on Wall Street, when you could count the number of publicly traded companies with your fingers. Now here we are with an investment product that allows you to own the entire market. This would progress even further in 1993 with the introduction of exchange traded funds, better known as ETFs, which have since become a staple of every investor's portfolio. We also have to talk about what happened in 1971. This was the year when trading began on the National Association of Securities Dealers Automated Quotations Exchange, better known to me and you as the NASDAQ. The NASDAQ, being a computerized exchange, allowed for stock prices to be updated electronically. Moving away from an in-person, physical-based exchange to an online exchange incentivized an overall better experience for the end investor. The spreads between bid and ask prices tightened as technology and market activity improved, leading to more certainty around the fair value of investments. What began as a semi-automated process mixed in with some telephone interaction turned into a fully automated end-to-end process. The NASDAQ was not only a stock exchange, but also an index itself, made up of the thousands of companies listed on its exchange. NASDAQ became a brand for new and exciting technology companies, and being listed on its exchange was somewhat of a cultural statement. NASDAQ's innovative contributions to investing would set the path for what was to come decades later. Today, many companies featured on the S&P 500 are listed on the NASDAQ. NASDAQ. The stock market has gone through its fair share of dark times since it was founded. In 1929, after the Dow Jones had increased sixfold since 1921, the great stock market crash occurred. This was the result of manic investor behavior with borrowed money and lots of it. In just a couple of short weeks, the Dow Jones had shed almost half of its value. This event led to the introduction of the Glass-Steagall Act of 1933, which effectively separated commercial banking activities from investment banking activities. And this wouldn't be the last time that notable changes were introduced following a crash. The stock market crash of 1987 led to the introduction of circuit breaker protocols to prevent panic selling in the stock market. You've no doubt seen instances where trading of a particular stock has been halted in order to curb volatility. Hertz and GameStop are two examples which come to mind. The point I'm trying to make is that the stock market and the world of investing is and always will be a work in progress. That brings me on nicely to the final part of this video, which is where we're at today and what the future could have in store for the stock market. It's really crazy to think that we're living in a time where you have access to the entire stock market at your fingertips. What would the Dutch traders in Handelsbeurs or the signatories of the Buttonwood Agreement say if they could see how far things have come? And I really do think we take a lot of this connectivity and accessibility for granted, but there's no doubt about it. The investing world is in the best place it's ever been. Technological innovations have democratized investing. Investing is now highly accessible, low cost, and for the most part, a seamless experience. As more and more online brokers enter the market, competition naturally increases. And whenever that happens, it's typically good news for the investor. What's interesting is that rules around restricted trading hours, which have existed since the 1600s, are still in play today. And while yes, it's possible to invest after hours, it's not a fully accessible 24/7 around the clock experience. Contrast this with the cryptocurrency markets, where you can invest anytime, any place. So I think the next step for stock market investing is committing to always open global markets. Investing culture has also undergone significant change over the last decade. Now, more than ever, people are taking an interest in their financial future. It's a really interesting time for the financial markets because you have all these other external factors like unsustainable state pensions, rising house prices and rental costs, and record levels of inflation. Do I know for certain what the future has in store for the stock market? Absolutely not. But I'm confident in saying that we're currently living in a time which will be noted as pivotal in the stock market history books of the future. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like in the video, subscribe to the channel, and I'll see you in the next one. Cheers!